The top 12 U.S. cities where landlords are panicking right now aren't the ones you think. And if you're investing in real estate anywhere in America, what's happening in these markets is about to hit yours next. We're about to show you rental market data that will shock you. One city just saw rents collapse 48% in 12 months. Another hit 10% vacancy rates, the highest in the nation. And in a third market, landlords are literally offering entire homes for $850 a month just to avoid foreclosure. But here's what nobody else is telling you. This isn't random market chaos. There's a specific pattern behind which cities are imploding, and we've identified the exact metric that predicted this crash 6 months before it happened. That same predictive signal is now flashing red in 3 major markets that haven't collapsed yet, and we'll show you exactly which ones at the 8-minute mark. There's also hidden construction data that reveals which of these 12 cities will recover first versus which ones are headed for an even deeper disaster. And this timing difference could mean millions in profit or loss for investors. Plus, we've uncovered a refinancing crisis brewing for landlords who bought at peak prices. And the tsunami hitting in late 2025 will separate the survivors from the casualties. Right now, while retail investors are panicking, institutional money is quietly positioning for the biggest distressed real estate opportunity since 2009. But you need to understand exactly what's driving this crisis in these specific 12 cities, because the patterns we're seeing here are the blueprint for what's coming to rental markets nationwide. Here's what our analysis of over 2 million rental units across these markets reveals. We're not dealing with a normal correction. This is a systematic unraveling of pandemic-era speculation, and the numbers are staggering. The construction data tells the complete story. During 2021 to 2023, these 12 markets permitted apartment construction at rates that defied every historical precedent. Austin alone approved 546 new units per 1,000 residents. That's 5 times the sustainable absorption rate. Charlotte delivered 4,700 units in Q1 2025 alone, triple their historical average. But here's the critical insight most analysts are missing. This isn't just oversupply. It's a liquidity crisis disguised as a rental correction. Property valuations have dropped 22.6% in Austin's worst-hit submarkets. And when you layer in 7 to 10% vacancy rates, the debt service coverage ratios are collapsing. 50,000 new units flooded Austin. 18,000 units hit Denver in 2024 alone. 22,000 units under construction in Charlotte. The pattern is identical across all 12 markets, and it's about to get worse. Let me walk you through the carnage, market by market. Each of these represents a different failure model in real estate fundamentals. And understanding the distinctions could save or make you millions. Number 1, Sarasota, Florida, the ground zero collapse. 48% rent destruction, 16.5% vacancy rate, complete market capitulation. Sarasota isn't just leading the list, it's rewriting the textbook on how quickly rental markets can implode. When we tell you rents dropped from $3,290 to $1,686 in 12 months, that's not a correction, that's a market reset to survival pricing. The mechanics here are textbook oversupply economics accelerated by policy intervention. The City Commission's 2022 pro-housing blitz, mixed-use zoning, density bonuses, $40 million in affordable housing subsidies, triggered a construction feeding frenzy. The result? 3,802 new units, hitting a market that can absorb maybe 1,200 annually. But here's the insider detail. Hurricane damage from Helene and Milton didn't just reduce demand. It triggered insurance cost explosions that are pushing marginal landlords into forced sales. We're tracking 15% of rental properties in Sarasota County currently listed for sale. When landlords offer 3 months free rent plus waived deposits, they're not competing for tenants. They're desperately trying to avoid foreclosure. Number 2, Austin, Texas. The tech bubble burst. 10.01% vacancy rate. The poster child for speculative excess. Austin's collapse validates everything we've been warning about regarding tech market speculation. This city epitomizes what happens when pandemic demand projections meet unlimited development capital. The numbers are brutal. 546 apartments permitted per 1,000 residents from 2021 to 23. To put that in perspective, a healthy market absorbs 150 to 200 per 1,000. Austin permitted nearly 50,000 new rental units while adding only 100,000 residents. The math was never sustainable. Properties financed at 2021 to 22 peak pricing are now facing refinancing, with rents down 17.44% from peak and vacancy rates at decade highs. Debt service coverage ratios have collapsed below 1 in many cases, triggering technical defaults. The equity destruction is catastrophic. We're seeing forced sales where investors are taking 30 to 40% losses just to escape debt obligations. The predictive metric I mentioned? Construction permits per population growth. Austin hit 5.46 times sustainable levels in 2022, 6 months before the collapse began. Right now, Nashville, Charlotte, and Phoenix are showing similar ratios. Number 3, Las Vegas, Nevada, the tourism recession. 4.6% rent decline, rising vacancy cascade, economic fundamentals cracking. Vegas represents a different failure mode, demand destruction rather than pure oversupply. The tourism sector is hemorrhaging international visitors, and that's cascading through the entire economic base. Single-family rental inventories surged 15% in 1 month, from 2,125 to 2,450 units. That's panic selling, not normal market turnover. When combined with multifamily oversupply, landlords are facing the most competitive environment in the city's modern history. Vegas is particularly vulnerable because its rental demand was artificially inflated by California exodus migration. As remote work policies tighten, many of these pandemic migrants are either returning to higher-paying coastal markets or downsizing to cheaper secondary cities. Number 4, Atlanta, Georgia. The growth story unraveled. 9% year-over-year decline, 13.6% peak-to-trough collapse. The affordable growth myth explodes. Atlanta's story should terrify every growth market investor. This was supposed to be the safe bet: diversified economy, population growth, business-friendly environment. Instead, it's become a cautionary tale about building ahead of absorption capacity. The construction data is damning. Developers built too much, too fast, assuming pandemic growth rates would continue indefinitely. Now we're seeing the predictable result. Millennial and Gen Z renters, making up the core tenant base, are either doubling up with family or leaving the metro entirely. Market intelligence. We're tracking 40% of high-rise developments in Atlanta now offering 90-plus day concession packages. When Class A properties resort to desperate incentives, it signals fundamental demand destruction, not temporary oversupply. Number 5, Denver, Colorado, the supply tsunami. 7% vacancy rate, 15-year high, 3.25% rent decline with concession cascade. Denver represents textbook supply shock economics. Over 18,000 units delivered in 2024, plus 6,000 more in Q1 2025 alone. That's 24,000 new units hitting a market that historically absorbed 8 to 10,000 annually. The occupancy rate collapsed to 92.4% by year-end 2024, triggered a concession war that's still escalating. When average rents hit their lowest level since 2022, despite inflation, you're seeing real price discovery in an oversupplied market. Downtown Denver's 7.7% vacancy rate isn't just the highest in the metro. It's approaching levels that historically trigger widespread financial distress among over-leveraged property owners. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue on to number 6. Miami, Florida, the wealth hub reality check. 6.7% rent decline despite 55% premium to national average. Luxury market implosion. Miami's correction is particularly significant because it's happening despite the city's status as a global wealth magnet. When high-end markets start declining, it signals that even affluent renters have pricing limits. The luxury sector tells the real story. Downtown Miami averages $3,634 rents, but new high-end inventory is flooding the market faster than international wealth can absorb it. The 7.8% vacancy rate represents a complete breakdown of the luxury scarcity premium. We're seeing unprecedented outbound migration from Miami-Dade, particularly among younger professionals who drove pandemic demand. Rising insurance costs and regulatory uncertainty are accelerating this trend. The construction data that reveals recovery timing? It's inventory months versus absorption rates. Markets with under 6 months of forward supply, like parts of Vegas, will stabilize by late 2025. Markets with 12-plus months of forward supply, like Sarasota and Austin, won't see stabilization until 2027. Number 7. Phoenix, Arizona, the absorption mirage. 8.4% vacancy rate approaching 10-year highs. Robust leasing can't keep the pace. Phoenix proves that strong demand doesn't matter if supply exceeds absorption capacity. Despite 17,000 units absorbed annually, double the pre-COVID average, the market delivered 23,000 to 24,000 new units in the same period. This is Supply Economics 101. When new inventory exceeds absorption by 35 to 40%, vacancy rates climb regardless of underlying demand strength. Phoenix is approaching a 10-year vacancy high despite being one of the fastest-growing metro areas in America. Number 8 to 12, the Florida correction cascade. Orlando, Tampa, Fort Myers, Cape Coral represent different phases of the same Florida oversupply crisis. Hurricane Milton delayed 2024 deliveries into 2025, creating a supply glut that's pushing vacancy rates to 20-year highs across the I-4 corridor. Fort Myers, Cape Coral deserves special attention. 10.61% vacancy rate, the second highest nationally, with entire homes available for $850 to $900 a month. That's distressed pricing that signals capitulation, not competition. The refinancing crisis we mentioned is hitting now. Properties bought or refinanced at 2021 to 22 peak pricing are facing loan-to-value gaps of 20 to 30%, with rental income down 15 to 40% and property values declining. Many owners face forced equity injections or default. The wave peaks in Q4 2025. Let me break down the market mechanics that created this crisis, because understanding these patterns is essential for predicting what happens next. Factor number 1, the construction algorithm broke. Every successful real estate market operates on a simple algorithm. New supply should equal absorption plus 3 to 5% buffer for healthy vacancy. The pandemic broke this algorithm completely. Austin, 546 units per 1,000 residents, should be 150 to 200. Charlotte, 4,700 units in one quarter, should be 1,500. Phoenix, 23,000 deliveries against 17,000 absorption, should be balanced. When construction exceeds absorption by 2 to 300%, you don't get a correction, you get a collapse. Factor number 2, the migration reversal nobody saw coming. Pandemic-era migration patterns created artificial demand spikes that developers mistook for permanent trends. Now those patterns are reversing, and the correction is brutal. Remote work policies drove 300,000-plus California residents to Texas, Florida, and Arizona. But return-to-office mandates are triggering reverse migration. We're tracking 40% of these pandemic migrants either returning to coastal markets or moving to cheaper secondary cities. Factor number 3, the renter capitulation event. This isn't just oversupply, it's demand destruction. Young renters who drove pandemic demands are tapping out completely. Student loan payments resumed, draining $400 to $600 a month from millennial budgets. Inflation eroded purchasing power by 15 to 20%. Wage growth stagnated at 3 to 4%, while housing costs rose 25 to 40%. The math broke, and renters are responding by doubling up, moving back with family, or leaving expensive markets entirely. Factor number 4, the insurance and regulatory multiplier. Natural disasters and policy changes created secondary shocks that amplified the oversupply crisis. Hurricane damage plus insurance cost explosions plus regulatory uncertainty equals perfect storm. We're seeing insurance premiums rise 40 to 60% annually in coastal markets, forcing marginal landlords into distressed sales. Factor number 5, the refinancing tsunami. Here's the hidden crisis. Properties financed at 2021 to 22 peak pricing are now facing refinancing with fundamentally different cash flows. A property bought for $10 million in 2022 with 75% LTV now faces 20 to 30% valuation decline. That equals $7 to $8 million current value, 15 to 40% rental income decline, broke debt service coverage, 6 to 8% interest rates versus 3 to 4% original rates. Result: forced equity injections or default. Factor number 6, the concession spiral. When landlords start offering concessions, it creates a downward spiral that's nearly impossible to stop. 3 months free rent equals 25% effective rent reduction. When Class A properties offer 90-plus day concessions, it forces B and C properties to match or exceed. This creates a race to the bottom that destroys pricing power across entire markets. Factor number 7, the institutional positioning shift. Smart money is quietly repositioning for the distressed cycle that's coming. Institutional buyers are raising distressed debt funds, preparing to acquire over-leveraged properties at 40 to 60 cents on the dollar. The opportunity cycle is shifting from development to acquisition, and most individual investors haven't figured this out yet. Here's what you need to understand. This correction creates the biggest real estate opportunity since 2009, but only for investors who understand the timing and positioning. For buyers, the opportunity window. Immediate action items. Target markets with under 6 months forward supply. Vegas, parts of Denver. Avoid markets with 12-plus months forward supply. Sarasota, Austin, until 2027. Focus on distressed seller opportunities and over-leveraged properties. Negotiate aggressively. Landlords are in survival mode, not profit mode. For current landlords, survival strategies. Critical decisions. If you're over-leveraged, consider strategic default before equity injections if you have liquidity. This is acquisition time, not hold time if you're breaking even. Ride it out. These cycles typically last 18 to 24 months. Refinancing reality check. If your debt service coverage ratio is below 1.2x, start planning your exit strategy now. The refinancing tsunami peaks in Q4 2025, and lenders won't be forgiving. Smart money is already positioning for the distressed cycle. Opportunity funds are raising capital to acquire properties at 40 to 60 cents on replacement cost. If you can't compete with institutional capital, consider partnering with it. We need your eyes on the ground. If you're in any of these 12 markets, comment below with what you're seeing. Concession escalation. Are landlords in your area offering more than 90 days free rent? Construction delays. Are projects getting stalled or canceled due to financing issues? Forced sales. Are you seeing institutional owners dumping properties? Rent negotiation success. Are existing tenants successfully negotiating significant rent reductions? Your local market intelligence helps everyone understand how quickly these conditions are changing. The bottom line, market timing is everything. This rental market correction represents the most significant wealth transfer opportunity in over a decade. But timing your entry and its exit is critical. The winners, investors with dry powder who can acquire distressed assets. The survivors, conservative landlords with strong balance sheets who can weather 18 to 24 months of reduced cash flow. The casualties, over-leveraged owners who bought at peak pricing with insufficient reserves. Our prediction: by late 2026, the markets with strong fundamentals, Austin, Charlotte, Denver, will have worked through their oversupply and begin recovering. The markets with structural challenges, some Florida markets, Vegas, may take until 2027 to 28. The key is understanding which category your target market falls into and positioning accordingly. Hit subscribe and that notification bell because in a market this volatile, timing your information advantage correctly could mean the difference between massive profits and devastating losses. The landlords panicking today are the same ones who bought into the real estate only goes up narrative. The investors positioning for opportunity today will be tomorrow's success stories. Which group are you in?